Welcome to today's market report. World stock markets rallied on Thursday and US dollar retreated from one-month highs as worries faded about contagion from China Evergrande and as investors digested the Federal Reserve's plan for reining in US stimulus. Wall Street's main indices all ended up at least 1% following solid advances in European markets. MSCI's gauge of stocks across the globe jumped 1.01%, its biggest percentage rise in a month, and for a third straight session of gains. That brought it all the way back from Monday, when it posted its biggest percentage drop in 2 months after fears linked to debt lantern property group Evergrande. It was a case of unwind of the fear from what happened in China. Markets got oversold and pessimistic very quickly, and then you have basically seen a buy the dip mentality. Evergrande shares jumped 18% ahead of a key debt payment deadline. Gold prices dropped as safe haven trades faded. Investors were still mulling in implications from the Fed's policy statement on Wednesday that it should begin reducing monthly bond purchases as soon as November, and signaled interest rate increases may follow more quickly than expected. In some ways, the Fed had prepared investors that they were going to taper, and somehow just getting that news out there, even if some people perceived it as more hawkish, is like a sign of relief. On Wall Street, the Dow Jones rose 1.48%, the S&P gained 1.21%, Nasdaq gained 1.04%. The Pan-European Stock 600 index rose 0.93%. Norway's central bank raised its benchmark interest rates and said it expects to hike again in December, joining a growing list of nations moving away from emergency-level borrowing costs. Norway's crown strengthened versus the euro to its highest level since mid-June. Benchmark US 10-year notes last fell 30 over 32 in price, pushing the yields to 1.4336%, its highest since early July, from 1.331% late on Wednesday. Key euro area bond yields also climbed after hawkish signals from central banks. Oil prices rose, supported by growing fuel demand and a draw in US crude inventories, as production remained hampered in the Gulf of Mexico after 2 hurricanes. US crude settled up 1.5% at $73.30 per barrel. The Brent settled at $77.25 per barrel, up 1.4% on the day. Spot gold dropped 1.3% to $1,745.29 per ounce. On the FX front, GBP/USD defends 137, recently picking up bids near 137.20 during a pullback from 50 simple moving average. Even so, the cable pair keeps the previous day's upside momentum, the heaviest since early July. That said, a clear upside break of a short-term resistance, now support near 136.60, joins firmer momentum and the ability to rebound from a rising trend line from July to keep buyers hopeful. Hence, the quote is likely to overcome the immediate SMA hurdle near the 137.50 during the further upside. However, 200 SMA near 137.70 and the September 17th swing high near 138.15 becomes the key resistance to watch afterward. In a case where GBP/USD rises past 138.15, the odds of witnessing a fresh monthly high past 139.13 can't be ruled out. The pound rallied over the Bank of England event, whereby 2 of its policymakers had voted for an early end to pandemic-era government bond buying. The BOE left its main interest rate unchanged at 0.1% and stuck to its £895 billion asset purchase target. This surprise, however, came with the policymaker Dave Ramsden voting for an early end to the QE, even though policymakers voted unanimously to leave interest rates unchanged. Ramsden now joins hawk Michael Sanders. Consequently, money markets have brought forward their BOE rate hike expectations with an initial 15 pips hike from the record low of 0.1%, now priced in for March 2022 from May previously. This has sent Britain's 2-year bond yield higher by 9 basis points to 0.37%, its highest since March 2020. Eurodollar again fades upside momentum below 117.50, retreats to 117.38 after rising the most in 6 weeks. The US dollar index was 0.5% lower at 93.037.
This is today's market news. Thanks for listening. We'll see you next time.